When you think about Ethereum likely being worth in the trillions of dollars long term, if L2s perhaps don't have exactly the same value accrual mechanism, but capture a meaningful amount of activity that ends up shifting from ETH mainnet and L1 to those L2s, then I think you can think about those networks maybe being worth 10 to 20% of the value of Ethereum. And that equates to hundreds of billions of dollars.
Hey everyone, welcome to the Edge Podcast. I'm DeFi Dad from Fourth Revolution Capital. I'm joined here by my co-host from 4RC Nomadic. Today we're joined by crypto investor Austin Barak of CoinFund. Austin was recently talking with me about how bullish he is on LSTs and L2 tokens, and it had me nearly fainting with excitement to find someone else as bullish as I am. So we're going to talk about his investment theses underpinning why DeFi is poised for such insane growth this next crypto bull cycle, led by sectors like L2s and LSTs. But before we do, just a quick word from our sponsors who make the Edge podcast possible.
MANTLE, a DAO-governed ecosystem of decentralized and token-governed technologies powered by MANTLE's native token, MNT. Its flagship product, MANTLE Network, is a high-performance Ethereum Layer 2 network built with modular architecture. At MANTLE, we're passionate about supporting builders and created a milestone-based grants program for promising Web3 projects. Calling for ambitious Web3 entrepreneurs. Visit mantle.xyz/grants and apply for it today.
Whether you're a trader, farmer, analyst, or newbie, you can trade smart with KyberSwap, the OG decentralized exchange and aggregator on 13 chains. Swap at the best rates, farm with real yields, set limit orders, use their proprietary trading and AI tools with the best UX in DeFi, securely and permissionlessly. Get better rates, better opportunities, better alpha, and a better trading experience. Trade smart now at kyberswap.com. G-Trade by Gains Network is a decentralized leverage trading platform, allowing users to synthetically trade crypto, forex, stocks, and commodities with up to 1000x leverage. G-Trade is live on both Polygon and Arbitrum, with over 30 billion in all-time trading volume and nearly 50 million in vault liquidity. The platform has consistently been among the top earning protocols, with 7-figure monthly revenue and a net deflationary token. G-Trade has become an on-chain stable for both traders and yield seekers. Check them out at gains.trade or by searching Gains Network on Twitter. The future of Web3 is bright, but crypto startups, DAOs, and on-chain organizations can't scale without tooling to power world-class financial and payment operations. Introducing Utopia, your all-in-one platform to create, execute, and understand your Gnosis-safe transactions. Execute payroll 10x faster through automated payment plans. Coordinate reimbursements and accounts payable through payment requests. Execute multi-sig transactions faster with your global team through signing links. View, label, and categorize all of your safe transactions in one place. Start managing your on-chain payments today by going to utopialabs.com. To get started with gasless payments, message Utopia's co-founder on Twitter at 0xkaito.
It all started so simply with CryptoKitties and Maker on Ethereum, but quickly became complex with more applications and many chains. Today, everyone agrees UX issues are the biggest blocker standing in the way of crypto adoption. Introducing Avocado. Multi-chain UX redesigned from the ground up. The first wallet to abstract networks, accounts, and gas. One gas tank to pay transaction fees on all chains. In USDC, and native access to Instadapp's powerful, custom DeFi strategies. Avocado, one wallet to rule all chains.
All right, so before we introduce Austin, just a quick bit of background. Austin graduated from the Wharton School and then later worked at Payoneer, a fintech company powering payments. He's been actively investing in and researching crypto since 2013, having previously founded a crypto startup back in 2018, which provided collateralized lending solutions for blockchain-based assets. Today, Austin is a partner at CoinFund focused on venture and liquid investments. CoinFund is a legendary crypto-native investment fund founded by Jake Brookman in 2015. Their team specializes in portfolio management, token design, decentralized networks, research, trading, market structure, engineering, brand strategy, law, and regulation. All of my favorite things. CoinFund has invested in countless foundational teams in crypto, such as Balancer, The Graph, Dapper Labs, and my former team at Zapper. I will also point out that Jake and Austin's team have been consistently early to the most enormous trends in crypto, including NFTs, NFT financialization, DAOs, and the metaverse. It is an absolute pleasure anytime we have the excuse to talk with our friends at CoinFund. So Austin, welcome to the Edge podcast. How are you doing?
Good. Thank you for having me. Glad to be here.
Awesome. Well, why don't we start with the usual, with your background, and talk a bit about, how did you discover crypto in the first place? I kind of gave a bits of that and how you actually were ahead of the DeFi curve with the crypto startup you founded in 2018, but would love for you to sort of connect the dots as to how you ended up at CoinFund.
Yeah, absolutely. It's kind of an interesting early exposure to crypto. So I have a hybrid finance technology background, studied finance undergrads, but went directly to working in startups, was early employee at Payoneer, as you mentioned, focused on cross-border payments for small and medium-sized businesses. But right around the time that I joined, I got a call from my brother, and he said, I was just playing a poker game and the buy-in was with something called Bitcoin. And I don't really know what it is, but I won some Bitcoin and can you help me set up the custody and figure out what this is? So we started diving down the rabbit hole, and this was 2013, and it was tangential to, what I was doing in cross-border payments. And, I was really intrigued, but it wasn't until 2015, 2016 with Ethereum when, it really pulled me in with this much broader surface area for application building. So from that point on, I think, anyone that's listening to this knows the story about, when you get sucked into the crypto rabbit hole. So 2016, 2017, started investing a bunch, working with some projects, going to a whole bunch of events and conferences. I actually took 1 week of vacation in early 2017 to go to all the New York Blockchain Week events. So just kind of decided to take the week off from work to focus purely on that. And early 2018 decided that I needed to go full time. So I co-founded a company called Promeritum, focused on collateralized lending. It was, early days of DeFi and learned a lot, found some early successes, but, ultimately ended up pivoting and joining a crypto ETP issuer called 21 Shares and was there leading strategy before ultimately connecting with the CoinFund team. And, the CoinFund team has been around since 2015, started by Jake, as you mentioned, but one of the most crypto native, funds in crypto. So I actually met them originally in Telegram, started chatting with some of the partners, and we just really aligned on thesis and vision and how we saw markets and where we thought things were heading. So I ended up joining CoinFund during DeFi summer in 2020 and have been there ever since, working across venture and liquid investing. So that's pre-seed to Series A on the venture side, and then, the full gamut of liquid tokens. And it's been quite a journey, couple cycles and, black swan events and craziness in between them. But it's an awesome group of people that I get to work with at CoinFund, but also broader Web3 ecosystem. So
that's awesome, man. I'm still a sucker for crypto background stories myself, and we definitely have some crossover. Just you mentioned poker. There's definitely a draw to former poker players to crypto, no doubt. And then I love the fact about taking a week off to go to crypto conferences. Like I remember I was just telling we have a chat open right now, and I was like, oh yeah, I took a day off work back in 2020 to buy land in a video game. Like, you got to do what you got to do.
Yeah, actually, this is kind of subject for probably another conversation. But one of the things that pulled me into crypto was I've been trading in markets for a really long time. So I started trading stocks when I was 10, and then equity options when I was 16. And there was a really big IPO one day when I was still in high school. So my parents let me stay home from school to trade the IPO. So I've been doing that for a while as far as, prioritizing things that I found most interesting.
That's awesome, man. trading stocks when you were 10? That's wild.
Yeah. It was actually September 10th, 2001 was the first day that I ever made a trade. So the day before 9/11, which, obviously the days after that were, pretty insane.
That is wild.
That is a crazy story. Yeah.
We could probably just chat like this all day, Austin, but I want to kind of dive into some of the questions that we've got for you today. So history doesn't repeat, but it often rhymes. Where do you think we're at in this current crypto cycle? If you were to map it to the last crypto bear market in 2018 to 2020, where do you think we are right now?
Yeah, that's a really interesting question. And I think these 4-year cycles have been surprisingly predictive of market movements, despite everyone saying like, oh, well, this is going to be, a bull market forever. It ends up matching up decently well. And I think we're actually in the beginning of the next bull market, which is a little bit difficult to map to 2019, 2020, because we had that COVID price decline in March of 2020. So, that's, if you look at a 4-year cycle, that would map out slightly differently. But I think that would map out to, early next year. But I think we've actually already seen the lows. The lows in Bitcoin were last November. The lows in ETH were last summer, and I don't think those will be tested again. And there's a couple telltale signs that seem to indicate that we're in the early stages of the next bull market. One, a lot of strong founders coming to market looking to raise capital, whereas the amount of founders that were willing to test the waters before was quite a bit less. We've also seen a pretty meaningful move in Bitcoin and ETH since the beginning of the year. Those two names usually lead the market, and it's usually a move, kind of a dominance trade in the early innings of a bull market. And then also, we're seeing pretty strong price action in fundamental names and some dispersion, so essentially lack of correlation, where we're not necessarily seeing, on a day where there's a big downdraft, we're not seeing everything get crushed or, everything go up in unison, but some meaningful outperformance in projects with stronger fundamentals or catalysts, which I think is indicative of the fact that people are picking their spots and not necessarily throwing the baby out with the bathwater on moves down.
Austin, are there any macro conditions or indicators or trends you're watching, given that there's this continual drumbeat about a recession that's like looming over our heads?
Yeah, that's an interesting question. And I would say I'm watching the key indicators as far as, where inflation numbers and CPI is coming out, what the Fed is likely to do, and, what we're seeing on, the banking side and some of the regional banking related events earlier this year. But broadly, I think it's a pretty constructive environment, even though there's some growth concerns. And the reason for that is 2022 was dominated by this macro headwind, where we had interest rates rising at, their most rapid clip in decades, and simultaneously, inflation growing and remaining quite high. And not to say specifically that this is going to turn from a headwind to a tailwind, but I think it's likely to be neutral right now. We're in a position where we can see some of the progress on the fundamental side within crypto. What I mean by fundamentals here is technology progress that's been pretty meaningful over the last year start to take hold. And that's because, rates are unlikely to rise from here. We're likely to see a pause. And if there's worsening financial conditions, maybe even some cuts. Inflation hasn't really started to decline much, but definitely isn't increasing. And we're seeing some early signs that it's under control. So yeah, I'm pretty constructive that we're in an environment where crypto markets have an opportunity to direct their own path versus being dominated by macro headlines for most of 2022.
I think a defining feature of the last bear market in 2018, 2019, 2020 is when you see the markets reacting to any sort of news, seeking like the worst sort of news, and you see those sell-offs, that's the most tumultuous part of the downtrend. But when you start to notice that the bad news is having seemingly little to no effect on the markets, which, by the way, there could be a whole debate here about whether or not any of that news is having an effect and whether it's already been priced in. But if we assume that the markets are reacting to these bits of news, I think we're at that phase now where, regardless of the bad news that comes out, regardless of what equities do, it seems like crypto is just consolidating. It's flat. It's unsure whether we're going to go up or down, but we do actually have some sustained uptrend since around January 1st, and it's not something to overlook. Like, it's a positive turn from the worst of 2022, where seemingly anything could tank the market ever since the Terra collapse, and then, of course, concluding, I think, with potentially the bottom for Bitcoin with the FTX collapse.
Yeah, I think that's absolutely right.
Austin, given some of the stronger founders you mentioned that you're starting to see raise again in the space, or I guess, better stated, what crypto verticals are you most excited for in this upcoming cycle, or what are those founders building right now, I guess, is kind of the question.
Yeah, there's a whole bunch of areas that we're really excited about. One of them is liquid staking broadly. So this is not just, liquid staking tokens themselves, but thinking about the infrastructure like DVT that can underpin further decentralization and liquid staking, things like, an eigenlayer, for example, and restaking, things like new DEXs that better support liquid staking assets and, borrow lend primitives. So I think as a category, it's definitely not a hot take to say that liquid staking is interesting and there's real product market fit. But then on the other hand, I think people are underestimating how critical liquid staking will be to DeFi and also how large it's going to get. But one of the interesting statistics that I think you can point to is liquid staking as a category right now. So if you look on DeFi Llama, it's the #1 category ahead of DEXs, ahead of borrow lends, ahead of CDPs in DeFi today. And when you look up at the addressable market, I don't think that, there's no sign that growth is going to abate anytime soon. So that's one. On-chain derivatives is another. Cross-chain interoperability, app chains, identity, mobile. So I just threw a whole bunch of things at you, but I bullish on all of those.
Actually, I want to work through each of these verticals. So why don't we start by covering LSTs, and we can work backwards into these larger addressable markets. I'm thinking LSTs to L2s I do want to touch on L1s. Any thoughts you have on L1s in this next run up? So can you talk to us more about some of the theses that underpin why LSTs are so undervalued right now? And I'm not sure if you're comfortable with it, but if you can throw any numbers behind it as to how big you think these markets could look for different LSTs.
Yeah, absolutely. So there's a couple things at play right now. When you look at the amount of ETH that's staked today compared to other proof of stake protocols, it's much, much lower. You have around 16% of total ETH staked, and most proof of stake protocols are directionally 40 to 60%. And then when you look at of the amount that's staked, only about 45% is liquid staked. So I think there's two drivers here that should meaningfully grow. On the amount that's staked, obviously, I think that'll go to the 40 to 60% range. So even ignoring any price increase in ETH, we're going to see 3 times the amount of dollar value of ETH staked over the next probably 2-3 years. But the interesting piece and the additional tailwind is looking at the percentage of ETH stake that's liquid staked. And I believe that will go to 80-90%. And the reason for that is the amount of flexibility, capital efficiency, and additional yield that can be generated. So obviously, if you're staking, you can earn the directionally 5-6% yields, but you're missing out on so much flexibility that you can otherwise be afforded with liquid staking at really a pretty minimal trade-off, which is the percentage of the staking revenue that you're paying to the staking protocol. And what are some of those benefits? So the ability to have immediate liquidity on the asset, which is the initial primary one. And now that there's withdrawals, and that's been enabled with the Shanghai upgrade, a lot of people say, well, maybe liquid staking isn't quite as critical because within maybe 2 days you can unstake your ETH. But I think it's missing the point that if you need to risk manage a position or you need to sell ETH for whatever reason, you need to sell it in that moment usually, and you're not necessarily able to wait 2 weeks. So if you're a very, very long-term Ethereum holder, as many of us are, then that's not really a concern. But as you see the market growing and more traditional investors getting involved in the market, but also wanting to take advantage of that yield, they need the ability to quickly risk manage, and liquid staking provides that. However, one of the more interesting things, and that's what makes it so potent within DeFi, is having this receipt token and this liquid staking asset allows you to do other things, whether it's collateralize the asset and borrow against it in the future, being able to margin that asset in, say a coin margin, perpetual protocol, and use that as collateral there, deposit in an AMM and earn additional fees by providing liquidity. So when you think about the additional value that you get from liquid staking, it's essentially a no-brainer, and that's why I see it becoming a much higher percentage than it is today. And instead of earning 5%, we can see a lot of Ethereum holders earn 10% plus on their ETH, plus have that liquidity.
Since we've gotten past the Shapella upgrade, it should become more and more of a default choice to just hold staked ETH. And if those numbers like 80 to 90% play out that you mentioned, and this is, I don't know over how many years, but we're going to see an increase in the percentage of staked ETH. And then that leads to the TLDR on this is that the backbone of DeFi is now staked ETH versus today it's ETH. But again, that's continually being de-risked, holding in that staked ETH. There's actually a tweet that you put out. I think this is a perfect framing of everything I just rambled about, which is ETH LSTs will soon be the base token for Ethereum DeFi. The protocols that lean into this earlier will gain a ton of market share. And that was in reference to a synthetics proposal to add, I think it was Steph by Lido, to add trading pairs for synthetics perps, which makes total sense. If you're going to trade perps for ETH, why not be passively earning some yield while you're, trying to trade the token?
Yeah, I think that's totally right. And it's unclear. So ST has enormous benefits as being one of the easiest to use protocols, but also one of the most liquid and has pretty dominant market share. I think it's not necessarily clear what model is going to ultimately end up winning out, whether it's via an aggregator, and we're seeing some early implementations of that, like Yearn is rolling out their YE, there's Unsheath and others that create essentially a basket of liquid staking tokens, or if it's protocols like Lido or Rocket Pool that ultimately become the 1-2 winners like we see in Uber and a Lyft and a Powerlaw dynamic after that. But one of the things that I think is most critical when we look at this backbone for DeFi is it doesn't really make sense to hold ETH, especially if you're participating in DeFi versus the staked version. So as we see this shift to people holding more and more liquid stake versions, that means that when you're looking to sell the asset, you're going to immediately go to the DEXs that provide liquidity for that staked asset itself versus necessarily trying to find it through a stable swap protocol. So if you have a pair be USDC staked ETH versus USDC WETH, it limits the hops that are required, and gives users a lot more flexibility, lowers cost, and a better user experience. And, with synthetics, for example, there's a whole bunch of advantages to having liquid staked assets as one of the tradable assets within a perpetuals protocol. So on the one hand, people that are long liquid staked assets can hedge risk if they believe there's some potential adverse event or market shock. But also you can more efficiently go long on a perpetuals protocol if, for example, you're going long wrap stake ETH, because that allows you to then earn the yield as it accrues in value on top of your bullish, leverage view that you're taking. So yeah, I think it's really exciting. We're seeing AMMs roll out that are purely dedicated to this. And when we think about what the size of the market is, I'm not going to give like any price targets or anything, but I think overall the liquid staking vertical and the market cap of projects within that vertical will amount to a number well over 100 billion. And the reason for that is, if you look at where most of us think Ethereum is heading, and that's to be asset value well over $1 trillion as the backbone of decentralized finance, resource networks, future social networks, and kind of broad global compute. And then you think about the position and the network effects that being some of the winners within liquid staking, what that achieves, and the income potential for those protocols, it starts to add up to some pretty staggering numbers. And these are also protocols that are pretty resilient to downturns. When you think about the tailwinds rather that they have that I mentioned earlier, these fundamentals are just up and to the right as a secular trend. More ETH staking, more liquid staking. And then from there, all of the additional DeFi strategies that can be stacked onto that. And I think, and we can talk about this, but I think there's likely to be a floor on how much fees will be compressed. So what it means is that these protocols have predictable revenues, and with predictable revenues and pretty strong growth, I think we'll see reasonable multiples that hold up, that trade above the multiples of other protocols that are perhaps less predictable on the revenue they'll be able to generate, which leads to pretty substantial outcomes.
We've had a lot of similar internal conversations at 4C, just kind of in regards to the thesis you just laid out with LSTs and generally like how big and how bullish that can be. And it's not a stretch, in my opinion, when you think about, these LSTs becoming core infrastructure for the second biggest asset, ETH. And yeah, I don't think that math is off base at all.
Well, one other thing to add there, I think we'll see more interesting and kind of expanded use of the token of those assets specifically to drive value within protocols. For example, Rocket Pool, there's a collateralization mechanism where RPL is used for permissionless validator to secure the ETH against slashing. And I think a lot of protocols will end up adopting this model as they decentralize further, which beyond the income that a protocol can generate as its fee share of total staking revenue, provides additional utility and can make these networks quite powerful. And that's not even to mention the growth that we'll see from restaking as protocols like Eigenlayer. I'm sure many of the leading liquid staking protocols will target this as well, where staked Ethereum can provide security to protocols beyond just Ethereum itself.
Absolutely. And we're seeing, LSTfi become a thing, right? Like we're seeing a lot of these baskets of LSTs become collateral for minting stable coins. And really you just got to get a little bit creative and project out how many more use cases we're not even thinking of will form and kind of iterate on this kind of new design space. So super interesting to watch.
That's one thing really, really interesting. That's one thing I actually even forgot to mention, and it's a really good point. What this will do for stablecoins, because one of the dynamics that we've seen over the last year as interest rates have increased a lot is declining total circulating stablecoin that sit on blockchains. And the reason for that is you can earn, risk-free with treasuries 4.5%, and the yields on borrowed for stables is quite low within DeFi today. It makes sense to probably pull out those assets. But if you have liquid staked ETH as collateral for stablecoins, now you can actually make stablecoins yield generating, and that competes with treasuries and could even be a higher yield than treasuries. So instead of just owning a stablecoin that gives you no yield, now you can have utility with your stablecoin, and that should drive further DeFi acceleration.
In terms of LSTs, you and I were talking about this previously, that there's a competition or a race to zero fees. How do you think about that in the context of these LST tokens? Like, that feels not optimal for those who want to own, a part of the Rocket Pool protocol through the RPL token or any other sort of protocol out there, the LDO token. I feel like we need fees. Like we've clearly seen from the last cycle, when you have a race to zero fees or lesser fees among AMMs, it works during the bull run, but then the bear cycle eventually hits, and it feels like a lot of these AMM tokens got weeded out, a lot of the forks of Uniswap. So I'm thinking about how that might relate to these LST tokens. And anyways, how do you think about what's optimal then?
Yeah, so I think that's a really good question. And, Rocket Pool and Lido take pretty different approaches today, where Rocket Pool as a protocol isn't charging any fees, but they require RPL to be locked up as collateral between 10 and 150% to earn rewards there and be able to access the network as a validator. Lido, on the other hand, doesn't require any LDO to be collateralized, but 10% goes to the protocol, split between validators and the protocol itself 50-50. And I think we're gonna end up seeing some convergence between these two models and different protocols trying different things. But one of the things that sometimes is missed when people say, well, maybe they'll just be fee compression to zero, is how important these really large professional validators are for supporting an influx of new staked ETH versus solo stakers themselves, because solo stakers are really, really important for decentralization, but don't necessarily have the infrastructural backbone to necessarily be able to onboard a large amount of Ethereum at once. And for these validator networks, it's really important to incentivize them. So I think fees that go towards these large professional validators will persist. But then when you think about, well, should the protocol take revenue or not? So similar to Lido or kind of looking at Lido and Rocket Pool's model, I think either way works. It's going to be hard to necessarily implement both, where you're requiring collateral and high fee takes. But also 10% of total fee that's generated isn't really that substantial when you think about the additional yield that can be generated by participating in DeFi. So I think there will likely be some fee compression compared to where we are today. And that's something that I saw earlier in my career in the payments industry, where as cross-border payments became, more established and better infrastructure was built, some of the take rates declined. But we do see it, level off at a certain equilibrium level that makes sense for all the stakeholders to participate long-term.
Meet Stater Labs, a non-custodial multi-chain liquid staking platform. With over 40,000 users across 6 chains, Stater is just about to launch ETHX, a decentralized liquid staking token on Ethereum. Backed by some of the biggest names in crypto, their multiple audits with top security firms, bug bounties, and real-time monitoring are a testimony to their emphasis on security and safety. With a unique multi-pool architecture and tokenomics, ETHX empowers stakers everywhere to run a node with as little as 4 ETH and earn 35% more than solo stakers. Sign up for their ETHX Alpha today and be the first to know about $1 million in staker rewards. Ethereum is fully decentralized, and Liquidity is a shining example of decentralization. Liquidity is a non-upgradable protocol where users can deposit their ETH and take out a loan interest-free. Users get their loans in LUSD, an unstoppable Ethereum native stablecoin that is solely backed by Ether. You can use Liquidity to buy real-world assets or to earn yield across 20-plus places in DeFi. More risk-tolerant users can also use the protocol to lever up on their ETH. With over 750 million worth of ETH locked into Liquidity's unstoppable contracts, get access to real DeFi. DeFi that's immutable, capital efficient, and fully decentralized. Learn more at liquidity.org.
Awesome. Let's switch gears here a little bit. I want to talk about L2s, but before we get there, I would love to get your thoughts on where you think the state of L1s are right now, and maybe like how you see them performing in this next bull cycle. A lot of them got pretty beaten down after some meteoric rises, but yeah, how do you see this L1 space shaking out right now, and kind of thinking of, you know, Avalanche, Solana?
Yeah, I think so. L1s and their evolution over the last 18 to 24 months has been really interesting. And what we've seen on the one hand is this gravitational pull towards Ethereum and the Ethereum ecosystem, if you include kind of ETH and ETH-related L2s. But what that's meant is we're seeing in other L1s a focus on specialization and the value proposition that brings to both developers and users. So, for example, on Avalanche, we're seeing a significantly increased focus on application-specific chains. Same thing with Cosmos. You know, Polkadot was very focused there. Polygon has their SuperNets approach. But what that means is being able to have these specific environments where there's no resource contention, there's customized blockchain build, there's a lot of flexibility, there's the ability to set your own token economies, and the use cases that generates, whether it's within gaming or within high throughput dedicated DeFi applications that don't necessarily require as much composability. So like a DYDX, for example, moving to their own app chain, this being within Cosmos, of course. But yeah, I think app chains have been a pretty critical evolution as far as some of the focus of different L1s or L0s. And then another is on meaningful infrastructural improvement and focusing in specific core verticals. So we've seen over the last 18 months, although the downtime is usually more publicized than the infrastructural improvements, Solana actually make a really, really meaningful strides on improving their infrastructure, whether it be through Quick, through local fee markets, their Fire Dancer client that is being shipped later this year. And we're seeing pretty powerful scalability at consistently low cost, supporting what's generally been the second most popular NFT market outside of Ethereum, except in recent periods with Bitcoin and ordinals, which we can definitely talk about as well. But what we're seeing in Solana is understanding that there's been pretty significant product market fit within NFT and gaming, and that ecosystem leaning more and more into that. So, I think with L1s, we'll see specialization like, NFT and gaming within Solana, Avalanche, which is focusing on app chains and chains specifically related to gaming and traditional financial use cases and tokenized assets. Cosmos, which has leaned a lot more into app chains related to DeFi, and that's how I see it evolving. But Ethereum has had this really big gravitational pull that's pretty evident.
Austin, why don't we dive into L2s next? We've got some context there on L1s to think about for the next cycle. L2s often get compared to, I think, the trend of L1s. There's a lot of economic activity on these L2s like Optimism, Arbitrum. We've now got the Polygon ZK EVM, ZK Syncs, ZK EVM is now live and growing very rapidly. So anyways, how do you start to think about how undervalued those are today versus where we're headed?
Yeah, so I think they're simultaneously fairly valued, undervalued, and overvalued. And let me explain what that means. And it really depends on your time horizon. So whether it's optimistic rollups or, like Arbitrum and Optimism or ZK rollups that we're seeing come to market now with MATTLE Labs' ZK Sync and Polygon ZK EVM, they've been really, really critical scaling mechanism for Ethereum that's allowed users to get a much better user experience than trading or kind of interacting with Ethereum mainnet. That's made it more accessible from a cost perspective, that it's made transaction speeds a lot faster. And we've seen a lot of activity shift there. So Arbitrum, for example, it depends which TVL stat you're looking at. L2 which has looks at more of the capital that's on the chain versus locked-in protocols. That has Arbitrum at 6 billion and Optimism at just under 2 billion. Or on, DeFi Llama would be, around 3 billion and $1 billion within protocols, but really meaningful activity. We're seeing Arbitrum, as an example, do about 1 million transactions a day. And we've even seen Uniswap volume on Arbitrum exceed the amount of Uniswap volume on Ethereum mainnet, which is pretty incredible. But when you think about how these should be valued, there's a couple different schools of thought. So one, right now, there's not a lot of revenue that's being generated by these protocols, and the revenue is not necessarily being distributed to token holders. And the revenue generated is primarily through the centralized sequencers, and over time, those will be decentralized either through shared sequencer or decentralized sequencers, and there's a whole bunch of different approaches to that. But then when you think about the opportunity so that's I think where it's, the critics will say, well, Optimism, Arbitrum being valued at 10 billion plus, Polygon and others probably pretty expensive if you were to ascribe some sort of multiple. Then if you say, well, maybe 10 or so billion FDV is reasonable, you can say, well, crypto markets are going to grow significantly and these are going to continue to gain share. And based on the size of crypto markets are, this was fair. But I think the argument that I believe in, where you can look at these protocols and say they're likely pretty undervalued, is having a little bit more imagination as far as what the utility of these tokens are in terms of potential security that they can provide for protocols and scaling solutions that even build above the L2s, what revenue and revenue generation potential can be driven by decentralized solutions within these protocols, and the value of governance within these networks. Then I think you can start to look at them very similar to alternative layer ones, and that's where I think you can start to have much higher price targets in mind. And one of the heuristics that the market had in the past was Ethereum is the benchmark for what a successful decentralized layer one, or in this case, if you're thinking about the two on the same plane, layer two network can achieve, and what percentage of the market cap should those be worth. And we've seen some of the largest alternative L1 in the last cycle be worth 20 to 25% of the market cap of Ethereum. And when you think about Ethereum likely being worth in the trillions of dollars long term, this is not a price target for 1 year or 2 years from now, but I think anyone listed in this industry is very, very bullish the long-term outlook for Ethereum. And you think about, even if, alternative L1s capture a fraction of that activity, or, conversely, if L2s perhaps don't have exactly the same value accrual mechanism, but capture a meaningful amount of activity that ends up shifting from ETH mainnet and L1 to those L2s, then I think you can think about those networks in a similar perspective at maybe being worth 10 to 20% of the value of Ethereum. And that equates to hundreds of billions of dollars, which is a lot higher than most all L1s or L2s that are worth directionally $5 to $20 billion today. So, that's some back of the envelope moon math thinking about, where Ethereum can might end up trading long term, and what the relative value of L2s or alt L1s could be. But it gets to pretty large numbers, and that's one of the reasons why we see whether it's L1s or L2s that have no activity today, but have the promise of activity in the future and usage and tracking the future because of interesting technology or a novel approach, why they're worth so much money. And the reason is, Ethereum has set this multi-$100 billion benchmark. And as long as there's something that seems like it can be whispered in the same breath as Ethereum, it's going to be worth a lot just on that low likelihood potential outcome.
Yeah, I can absolutely see some of these L2s reaching $100 billion fully diluted valuations and potentially much more, something that is, let's say in this case, 200 billion, 20% of where Ethereum is. So anyways, we are at that part of the cycle where people are pretty beaten down from the bear market, and some of the, I think the euphoria, the sort of mindless bullish thinking that happens in the bull market, we've forgotten all of that, but it will return. I'm not an advocate of that, but I'm just saying, like, the masses always get too bullish during the bull cycle and too bearish during the bear cycle. And personally, I'm a little more comfortable in this type of cycle where I think we're at a turning point, and I'm confident that, in the world of DeFi, we have long-lasting utility here to keep us going as a community, even through bear cycles.
Yeah, I think that's totally right. And 2022 was a really tough year for Web3. There's a lot of emotional scarring going through that bear market, and I think it's probably tougher for people in crypto than in other industries, because most people that work in crypto is also their main hobby. So it's a double dose. You don't have the respite of like, well, I'm gonna, I don't know, kind of read this other interesting, thing or whatever. You're kind of doing it in your work hours, so to speak, but also researching and working on crypto in your free time. But yeah, the opportunity is really large, and it's important to regain that imagination. And the trillion market cap that we were talking about, that equates to just over $8,000 per Ethereum token, which is not even at the levels that people were calling for in the last bull market, when they were saying like, oh, we think the price of Ether can reach 10,000. So yeah, lots of potential. Not financial advice, but this is a group of three people that are quite bullish.
Wait, before we move on to the next point, just something else popped up in my head. What about the ETH burn? We haven't even discussed that. Do you have any thoughts on the ETH burn? It's been unreal to watch it on ultrasound.money. I think if we're looking at the time frame going back to since the merge, so as of today, May 23rd, 2023, it's been 250 days since Ethereum moved to proof of stake, and now we have this burn mechanism, which has burned 256,667 ETH. I don't even know how much that's worth based on prices today, but I'm not going to do the math. It's a lot of money, and we're not even in a bull run. Like, we're seeing gas prices relatively high for at least a few months. I think gas prices have been hovering between, this is on Ethereum mainnet, between like 50 Gwei and unfortunately as high as like 300. Today it's around 75. Any predictions for where we're headed in terms of the ETH burn?
It's this really bullish catalyst that people that are, live and breathe crypto talk about all the time, but I don't think is widely understood outside of crypto. And the really powerful thing, you're talking about the, reduction in Ethereum supply. That's despite the fact that there's 4% or roughly 4% annual inflation. So this is offsetting all of that and that resulting in a decline. I think I saw a tweet yesterday that I think at current levels, it's burning about 100,000 ETH per month, which is a little over $1 million a year, which is about 1% of Ethereum's current token supply. So when you think about Ethereum not being an asset that's hard capped at a particular supply, but actually declining in supply, and there'd be, for folks that are more familiar with stock markets, this is the equivalent of every 15 seconds, every time there's an Ethereum block, having a stock buyback. Stock buybacks are bullish in traditional markets. This is a consistent stock buyback based on the activity, the organic, real activity that's happening on Ethereum. So by owning Ethereum, you're getting an asset that's providing a yield higher than what typical dividend stocks provide, and more similar to what a corporate bond would be providing, or treasuries in this unusual time where treasuries are quite high, but also being a massive growth asset, and then at the same time an asset that's deflationary. It's incredibly powerful, and is something that I don't think is widely understood outside of crypto, and it's going to drive a lot of asset flows into Ethereum this cycle. And that's not even taking into account all the Ethereum that's likely to be locked up in DeFi for a whole bunch of use cases, maybe even just decentralized stablecoins. So you think about Ethereum supply declining, Ethereum being locked in DeFi, it's pretty potent.
Yeah. As of today, the inflation rate or the deflation rate here it's negative 0.31%. And again, this is all, us taking the numbers since the merge about 250 days ago. What's even wilder here is you have to think that, will Ethereum continue to grow in terms of utility? Will we have more users? Will there be more competition for block space? I think that's pretty safe to say yes. And so as that continues to increase, and as you add in the wild nature of like a bull market, it's very likely that the burn rate could increase from here. And so it goes back to what you said, Austin. You have ETH as of today. I wish I knew the exact number in terms of the percentage of ETH of the total supply that's been staked. Do you know that, Austin, off the top of your head?
It's about 16%.
Okay. Yep. So we're talking about 16%. So more's being locked up, and then we've got this burning mechanism. This is clearly not understood by a lot of people. I mean, otherwise, I feel like it would get talked about even more, but it tends to get talked about again amongst the most, I think, advanced investors and users. So just really exciting times. It feels like a secret that everyone should know, but fewer do know. And I would invite you to check out ultrasound.money. They lay out all these great stats. It's very dummy proof. You can kind of click through and the dots will start to connect, and your bullish brain will explode on your computer screen.
Yeah, I have one friend that he posts a screenshot of the ultrasound money chart and how the supply is declining, and all the time he's like, this is literally the only chart that matters. And it's important to put that in front of people, because it really does matter a lot.
He might not be wrong. I could linger on this conversation, this topic for the rest of the pod, but I want to talk a bit about what's happening in the Bitcoin ecosystem right now. I'd say over the last 3 to 6 months, we've kind of seen an explosion of activity, the emergence of BRC20s, ordinals, some L2 movements with stacks. I was looking today, and Bitcoin is second in NFT trading volume, I believe, only to Ethereum right now. And that's kind of sustained over, I think, the last 48 hours. And then further to the L2 comment, Stacks has their Nakamoto release coming up at near the end of the year, which will make it a lot more sort of feature parity to the UI UX that we have come to know and love on other Ethereum L2s. So if you could just walk us through what you're seeing in this space, does it have staying power? Just your general thoughts.
Yeah, so I definitely think it has staying power. The question is just what shape and form does it take in its evolution from these early days of new experimentation on Bitcoin. But I think looking at what we're seeing with ordinals and inscriptions, with BRC20s, even continued growth in the Lightning Network, Stacks upgrading to the Nakamoto release and releasing SBTC, which provides this trustless bridge to allow Bitcoin to more easily engage with DeFi. It's this new era of open innovation with Bitcoin that we haven't seen in a while. And the really powerful thing there is, it's easy to kind of understand broadly that Bitcoin is the largest asset within crypto. But when you look at the exact numbers and see that Bitcoin is a $530 billion asset, that's more than double the value of Ethereum. And that asset base is now being open to DeFi, being open to broad experimentation in a way that it really just wasn't before. I think that's the really powerful piece here, that you don't necessarily need to be bullish on just ordinals or just Bitcoin DeFi or kind of some of the early experiments with the BRC20s, because what this means is we're going to see so many more experiments and so many more different products released. And some of the numbers that I think are pretty potent in these early days. Over the last 30 days, $170 million of ordinals have traded versus 392 million on Ethereum, 56 million for Solana, and then much lower numbers for other ecosystems. And this is 170 million that came out of nowhere, right? That it just didn't really exist at all a couple months ago. It is also a pretty novel mechanism versus just NFT and other ecosystems via the inscription mechanism, and kind of how that differs. We don't have to dive too deep into the tech there. But what this means is it's pulling in a new re-energized set of users and developers to Bitcoin, making the opportunities seem pretty limitless on, what I mentioned, $500 billion of assets. And when you think about what this means for an explosion of DeFi, then whether it's, via Stacks or on Bitcoin itself or elsewhere, total DeFi TVL is around $50 billion today. And if you think about it as a rough proxy for the amount of Bitcoin that engages with DeFi today, you can look at WBTC, which is the BTC that exists on Ethereum, and that's $4.3 billion. So if we even see 10% of Bitcoin collateralized and start to engage with DeFi, that's all of the DeFi TVL today, and that's 10x what WBTC is. So it's pretty large numbers, and also just really exciting to see the addressable market of DeFi and NFTs and kind of broader applications expand so much further by pulling in the entire Bitcoin ecosystem.
Yeah, I personally think it's super exciting as well. I'm kind of like the Bitcoin advocate on our team, I'd say. But there's a part of me too that has just seen Bitcoin as being this simple meme that everyone could understand, this store of value. Do you think there's any risks here to opening Bitcoin up to this new design space and kind of getting away from its core principles, and then maybe not executing as well as the other offerings in the space that, the Ethereum network? I think net, I'm bullish and I'm positive and I'm happy, but it's not without reservations, because it is upsetting kind of the status quo, what people have come to know and love about Bitcoin. I also see potential new hard fork wars emerging from this. I see a lot of retaliation. I do think the maxi camp has gotten smaller and smaller and less vocal and almost drowned out by this new cohort of people that are just excited for Bitcoin innovation. But yeah, curious your thoughts.
Yeah, I think there's this interesting balance of interests that end up that we're reaching between the folks that are more purist and those that are kind of trying all these different applications. And fee revenue is the reason for that in my mind, where there was always this question of, as we have Bitcoin halvings over time and the block rewards decline, how do you create this sustainable incentive for miners to mine Bitcoin via proof of work? And because of all this activity, we're actually seeing really, really high fee income for miners. And that's the first time in a really long time that that's happening. So this makes Bitcoin a lot more sustainable. And in my mind, Bitcoin's value as, a store of value in a digital gold like that is in its security and in its relative immovability. And what I mean by that is it's very, very hard to change. And as long as the security and this really large ship with a small rudder kind of dynamic persists, then I think you can satisfy the more Bitcoin pure store of value camp, along with the people that want to experiment more, and the fee revenue brings them together. It's kind of the same thing with Ethereum, although I don't think with Ethereum, people are as dogmatic about store of value because it had different origins. But, as much as sometimes people like to discount meme coin trading and say like, oh, it's ridiculous, it's creating a lot of fee burns with EIP 1559, which is leading to supply reduction. And then this kind of it magnifies the store of value mechanism for Ethereum itself. So I think there's both sides of the coin that end up converging.
Yeah, I have always believed that if a network, whether it's Bitcoin, Ethereum, if it's being used more often, if there's more competition among users to be able to get their transactions confirmed, that should somehow be priced back into the token. And I don't think it makes sense at this point in the evolution of crypto to just rely upon that information being priced in by speculators. Like, I think there has to be an actual mechanism. And I think Ethereum clearly has set the standard. I think, yeah, Bitcoiners should be super happy about this. Like, do you remember a year ago, like how pathetic the fees were? Like, if you look at crypto, I think it's cryptofees.info, it was becoming a joke. It was like 20. I remember at one point noting Ethereum had 20, 30, 40x the fees of the Bitcoin network. And my concern is more long-term for Bitcoin. It's that if we don't have enough fees on the Bitcoin network, and if the price of Bitcoin doesn't keep pace to keep incentivizing the miners that are, essential to running the network, then there's a real existential crisis there. So, I think despite some of the infighting amongst some toxic personalities there in the Bitcoin community, I'm betting some of them are going to get on board. Like, I definitely think of someone like, what's Nick's last name? What's his name? Poor Nick. Can't remember his last name. What's the guy's name from Castle?
Nick Carter.
Nick Carter. I think of people like Nick Carter who, were like a holy savior of the Bitcoiners. And, I think he very bravely stepped out to say, hey, it's not all about this very purist form of Bitcoin. And those sorts of voices are probably going to do very well in in my opinion, in the future of the Bitcoin community. But I don't know. What do I know?
Just quickly on that point too, like guys like Adam Back, who, traditionally kind of like you could probably put in the maxi camp, is, I believe, for putting in new opcodes into Bitcoin to make this, like some of these L2 upgrades, even more like native and organic for Bitcoin transactions and pass-throughs between L1 L2. So kind of shocking and surprising to see that kind of turnaround.
I've been so checked out of Bitcoin until ordinals exploded, because I just felt it was boring. Like, it put as simply as that. I prefer my Bitcoin on Ethereum. And in 2020, there was an explosion of value deposited into Ethereum DeFi, which was really the only DeFi at the time, because of wrapped Bitcoin, because of SBTC by Synthetics, because of Ren BTC. So to Austin's point, I think there is going to be a wild market ahead of us as this enormous $500 billion plus, market cap of Bitcoin is potentially being used in what we're calling Bitcoin DeFi. And it's exciting. Again, whether you hold Bitcoin only or you use that DeFi, I think that everyone's going to benefit from this like increased utility over time. Austin, just a few more questions for you. Wanted to touch on how are you and CoinFund thinking about the synergies between Web3 and AI? Just an easy question for you there.
No, it's
simple
pretty
stuff.
simple. Yeah, so I think there's a lot of meaningful synergies, and we've been spending a lot of time thinking about it over the last year or so. But one of them in particular, I think is pretty interesting when you think about combining resource networks within crypto to prove out AI models and do a lot of the heavy lifting there. And what that enables as far as expanding the computational capacity for building out these models, meanwhile bootstrapping decentralized GPU markets that I think are really beneficial to other industries as well. So that's something that we're seeing that we're pretty bullish on. But also something that not a lot of people have focused on is how can that impact the UX layer, where we're seeing so many, for example, ChatGPT plugins to Web2 applications, and Web3 is notoriously complicated to use, let's say, to frame it lightly. And that's why there's so many, more technically focused users as the power users within DeFi and decentralized social networks. But if you can build in some of the tooling from this recent explosion in AI to make the user experience a lot easier, that's something that I think is pretty potent. And then also just broadly thinking about the ethos of both developing open source models, we believe this is really important and creates a playing field that allows this open experimentation, but also I think negates a lot of the concerns that people have about growth of AI. So we love that we're seeing a lot of open source development in AI, just like we're all believers in for crypto Web3.
Let's just talk quickly about regulation, everybody's favorite topic. Just kidding. I want to kind of get your take on, I guess the theme of this is are US teams being somewhat left behind, almost with this like regulatory arbitrage that's happening? We're seeing this real yield meme move from meme to it's a thing, right? Like, everybody wants real yield, everybody wants value accrual. Hard to do in the US with current SEC laws and just following the regulatory framework, whatever it may be, and however confusing and gray it is currently. But we've kind of seen this play out with like Binance and FTX and how they can kind of outcompete Coinbase, which is fighting that U.S. regulatory battle. How do you think about this in relation to, I guess, maybe anon teams or teams in other jurisdictions that can really open up the design space on tokens? Whether they can or can't is in question, but they do. Just how do you see this as, an investor investing in U.S. teams and thinking about kind of this problem with, are U.S. teams kind of behind the eight ball when it comes to creating tokenomics that appeal to users?
Yeah, that's a really good question. And I think it is tougher for U.S. teams, particularly just because of the lack of clarity. I think, founders and technologists are very willing to operate within the frameworks that are set. But if you don't know what that framework is, you're walking on eggshells. And we've seen a lot of founders move to different parts of the world, particularly Europe. Lisbon, it's seen massive growth in the Web3 community there. A lot of growth in the UK. I think the UK has actually been pretty progressive as far as adopting and supporting Web3 because, financial markets are really the lifeblood of the economy in the UK. If DeFi is going to take a really big piece out of that or what I think long-term actually complement that and grow to be a really large part of the global financial markets, I think they recognize that in some of the regulatory frameworks that we're seeing abroad, like MICA and elsewhere, that are providing that clarity. So yeah, it makes it tougher for U.S. teams, but we're still continuing to fund lots of U.S. teams. And there's obviously very strong founders that are building in the U.S. But you need to make sure that you're being more conservative and more cautious, perhaps even more so than would be required by the SEC itself if they had just given more clear guidelines. So we're bullish that regulatory will be resolved within the United States, and there's a lot of really smart, really passionate people in government that are supportive of crypto. It's easy to look at the negative headlines, but there's also a lot of people that want to see crypto and Web3 succeed. So it's in large part, I think, an education process in making sure that legislators in different branches of government understand the true value that's being built here, because it's so easy to anchor to like a scammy NFT drop or a meme coin that you're like, oh, this shouldn't have any value, when really the goal of crypto and the mission for why we're all involved here is creating this permissionless, open financial and social system to improve connectivity and open kind of access to the people that have the least access in the world. And I think that's something that most people, will end up rallying around.
Yeah, I have optimism that for those who take the time to educate themselves or have staff that educate them on crypto, they'll see the light on that permissionless access to all the different things you can do with DeFi and Web3 and so on. The issue is, in the short term, there's a lot of noise that's being made by the less informed. And unfortunately, like the queen of the anti-crypto army is Senator Elizabeth Warren, which, funny enough, is my senator. I get to vote her out next election, I hope. You have folks like that who make a lot of noise. And if you listen to what they're saying, there's no meaning behind it. Like, they really don't even understand what it is that they don't understand the underlying technology behind crypto, or I'll say DeFi, Bitcoin, Ethereum, and so on. And I see it similar to the wealth creation event that the internet was, that at some point, really smart folks recognize the opportunity, and those are the folks that hopefully then are able to, spread the word and help others to see the light there, that have the powers that they do in Congress and as regulators. And so, yeah, we got to just, we as a community, we need to vote in these upcoming elections with this as one of the most important like issues on the ballot. Like, I am not someone to speak about politics, but I can tell you when I go to vote, I don't care what party it is. If you're pro crypto, and as long as you're a person of moderate integrity, I'll say I'm looking to vote for you. And that, I think that's how we have to be. We have to look out for ourselves because of the fact that there are a lot of people gunning to, for whatever reason, turn crypto into the enemy, the thing that the scapegoat that we blame everything on.
Yeah, I mean, crypto is all about financial inclusion, but also if you're in government and you're trying to prevent monopolies within different industries, and there's been a lot of talk about that over recent years and the power that, you know, the handful of large technology companies have. Decentralized networks couldn't do a better job at eliminating monopolies and giving fair access to, you know, new startups, new builders, pricing power for individuals. So yeah, it's very important that we all rally to make sure that, you know, crypto can thrive. But the really great thing about crypto is it doesn't necessarily need anyone's permission. So it's going to keep chugging in the background, and it does its thing.
That's why we're all here. One last question for you. Are there any other trends on the horizon that you see forming in crypto that, you know, we as investors and users should pay more attention to?
Yeah, so I think there's two things that are really interesting. I'll give one short-term and one long-term. On the one hand, the short-term one is growth in on-chain derivatives markets. And if you look at derivatives markets broadly, those are typically much, much larger than spot markets. And that's not even the case in crypto. So I think you have that tailwind of derivatives markets growing from where they are today. But also the percentage of DEX volume to centralized exchange volume for spot, 20% of volume or so is on DEXs. However, for decentralized perps and decentralized options, it's about 1.5%. So 10 times less on-chain volume for derivatives than it is for spot, right? I think we get a lot closer to the numbers that we're seeing for DEXs. And there's a ton of really interesting protocols, whether it's, you know, DYDX or synthetics or GMX, a lot of really interesting experimentation, and also experimentation in permissionless market creation that allow these markets to grow and thrive and move a lot faster. But also in mechanisms that allow them to increase the liquidity so that they can pull in larger participants. So that's one. And then the other is real-world asset tokenization, which I think is something that we're all excited about in terms of tying together more traditional markets and, you know, more traditional asset classes with crypto and allowing those asset classes, whether it's fixed income or real estate or equity markets, to benefit from the efficiency technologies that blockchain provide. But there's a lot that needs to be worked out, whether it's on the compliance side, of the identity side, the KYC side, education. So I think it's going to take a while for RWA adoption, but it's something that will happen and will be really large. So short term, derivatives are going to grow. Long term, RWAs will be something to watch.
I could not be more in agreement, especially on the derivatives front. If you want to learn more about decentralized perps and leverage trading in DeFi, I would highly recommend folks listen to, I believe the earlier episode is with G-Trade by Gains Network, and then we just recorded with one of the core contributors at Quenta, which is like the #1 front end for synthetics perps trading. And then there's others, of course, like GMX you got to check out, and actually many others here that will probably emerge. Austin, this was fantastic. This is probably a great place for us to wrap. I want to remind listeners that they should follow you at Austin Barak on Twitter. They should follow CoinFund at CoinFund_IO on Twitter. They should also check out CoinFund at CoinFund.io. Anything else, Austin, you want to share in terms of how folks can follow your work and CoinFund and potentially get involved with any of the projects you invest in.
Yeah, feel free to reach out to us. Follow us on Twitter. Reach out to us on Twitter. My DMs are open if you're a founder or developer that's kind of experimenting or building something new. Always go out to chat. We write pretty actively on our blog. And we also host weekly Twitter spaces. So definitely keep an eye out for that. But we're accessible, and we're one of the things that's awesome about the crypto community is that it is a community, and everyone is really open and looking and is glad to work together. And we definitely live that ethos. So feel free to reach out.
Thanks everyone for tuning in. If you're a talented founder or developer, please consider reaching out to our team at fourthrevolution.capital. And for future episodes of the Edge podcast, please check out our link tree at edge_pod.